The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The animal spirits are back and they're rotating like all get out into small cap stocks. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Let's get a check on where markets stand right now with 1 hour to go in trading. The post-election rally losing a little bit of steam in equities here with the S&P 500 little change. It was down in the red earlier, but a lot of movement into those small caps as part of the big Trump trade. This idea that these companies are more sensitive to faster economic growth under a second Trump administration. The dollar has been moving higher. That's been the trend all along, with a bump or two along the way. And the bond market is closed today because of Veterans Day, but there is a look here at U.S. Treasury futures. And this is the price, not the yield. So prices right now down about 1/3%, Romaine.
Yeah, let's go to the Russell 2000, 2434 and change. Keep your eyes on that space, 2442 and change. That was the record high set back by the Russell back in November of 2021. And that is a big part of the Trump trade. Small companies, of course, they've been hobbled for years by high interest rates and heavy regulation, but now they are potentially in line for some relief from those political promises of lower taxes on their businesses, higher tariffs on their foreign competitors, and a lighter regulatory touch overall. Small caps, the biggest beneficiary so far of the post-election animal spirits. Meanwhile, the animal spirits for crypto, well, they're just as wild. Full beast mode right now for Bitcoin, which at one point on the day was flirting with 87,000, if you can believe it, as we speak. A more than 28% rally since the day before the election, and more than double from where Bitcoin traded just back in late January. Euphoria? Sure, but it's euphoria around a president-elect who campaigned on an embrace of digital assets. It's also euphoria around 4 dozen congressmen elected last week who specifically pledged to be pro-crypto.
Given where we're at, I wouldn't put 150K out by the end of next year. And I still think that 100K was within reach this year as well.
No animal spirits, though, for treasuries. While the bond market is closed for Veterans Day, it has been caught since the election between conflicting expectations of fiscal policy changes and the Fed easing cycle. And that's prompted some folks to shun buying longer dated bonds at the moment. Citi, JP Morgan, and Morgan Stanley strategists among some of the big banks out there right now, Scarlett, still clinging to a neutral recommendation when it comes to bond duration.
Yeah, everyone still needs to sort out what this means for the bond market. So let's turn back to equities right now. We know a buoyant stock market is a big part of the Trump trade, and this chart really shows the extent of the bullishness. Now, speculative positioning on the S&P 500 turned long in early October. We saw a bit of a wobble the following week, but then things turned decisively long in mid-October. And from that point on, there was really no turning back. Net longs on the S&P 500 are now at levels not seen since going all the way back to 2022. JP Morgan says the stock market could rally stronger into the year end than it did in 2016 when Donald Trump last won. Romaine?
All right, let's kick you off to the close here on this Monday afternoon. Ken Shinoda joining us right now. He's portfolio manager over at Doubleline Capital. And Ken, we haven't spoken since the election. You've seen the rally in the equity space. And of course, you've seen a lot of the volatility in the bond market space as well. Do you have any sort of sense here as to where yields may go next and whether that is indeed going to be driven by policy coming out of Washington?
Absolutely. The rise in yields started when the probability of a Trump win started increasing after the September FOMC meeting. And we saw a big sell-off on election night and in that morning. But the market's kind of settled down here. I think it's kind of a little bit of a buy the rumor, sell the news. The research analysts all talk about this big fiscal stimulus that could be coming, more deficit spending. But in reality, we have to kind of wait and see what they're actually going to roll out. It could be some cutting of spending too, and I think that's maybe why the bond market had settled down. We reached critical kind of 450 area on the 10-year, and we had a really good 30-year auction last week. It was the best auction since 2018, so we got some dip buyers that stepped in.
You know, there are a lot of layers, of course, to the Trump trade, a lot of layers to what's going on in the fixed income market. And when you look at the rally that we've seen in small cap stocks, whether you want to take the Russell or the SML or whatever, I'm wondering, Ken, if you think that that could potentially translate into more euphoria around some of these small cap companies and their debt.
Definitely. I mean, what the bond market is pricing in is good times to come because spreads on investment-grade corporate bonds are at a post-crisis, when I say post-crisis, post-global financial tight with a 7 handle. We broke below 80. And high-yield bond spreads are also at a new post-crisis tight. So the market is saying that they don't believe defaults are going to be that high and that the economy should be rolling along, and we'll see minimal defaults in those corporate credits.
So does that make corporate credit in the high yield space more attractive than small caps, given the run-up that we've seen already in small caps?
Small caps probably have a little bit more room to run, but if you look at the equity market broadly, we've seen a stellar year. I mean, I think we've made 50 new all-time highs.
Yep.
But given where valuations are, the forward-looking returns using PE ratios or cyclically adjusted PE ratios call for low single-digit returns broadly for U.S. equities. So where you can buy some of these credit assets up near 7%, that could be competitive for equities.
I want to go back to something you mentioned, which is this idea that there might be some cutting of spending. What is the scope for that, and how much of it does it depend on the economic data that we get? We know the Fed is very data dependent and is going to be in reaction mode more than anything.
Well, I hope we cut spending. We'll have to see if it happens. But, Elon Musk has been a big proponent of Trump, very vocal out there, saying that he's got ideas on how we can solve the deficit. So it's a lot to hope for, but at least I think we have a potential chance. And I think that's what the market is looking for, is guidance on, yes, we know there's going to be tax cuts that's bad for the deficit, but perhaps on the other side, we could see some cutting of spending as well.
When do you think we are going to get a little bit more clarity on how that all balances out? I mean, this is something that I think, at least on the surface, I would think could take a few months, maybe even longer, before we have a real sense here of what that equation looks like.
I don't think we're going to really have a good idea till we're in the first quarter next year and Trump comes into office and we see how things play out. So a little bit of time before we get more clarity there.
When it comes to this idea of how other areas of this market could be affected by some of those policies, I want to talk a little bit about what we were seeing in the commercial real estate market, particularly when it comes to some of the asset-backed debt. And I'm wondering if there is a direct feed-through that we can look to as investors from some of those potential policy changes and any relief that we see in that sector.
Well, there's going to be pushes and pulls in the commercial real estate market because they're really debt driven. So to the extent that interest rates have moved higher and stay higher, that's a headwind. Now, at the same time, the debt markets have opened up. While the banks aren't really lending aggressively, the CMBS market is wide open. So buyers of real estate have the ability to get debt and invest in assets. And we're seeing renewed interest both on the equity and debt side. Of buying assets, investing in assets, lending. So that is a tailwind, is the availability of debt. And if corporate profits increase because of tax cuts, then maybe they'll be expanding their businesses. Maybe they'll be taking out new office space, renewing that lease, and you'll just see general activity for those commercial properties increase. And that's a good thing for them.
Right. Now, there are a lot of hypotheticals that we're speaking in here, Ken. This could happen. We're looking for this to happen, and for good reason, because we do know that President-elect Trump has made good on many of his campaign promises. But with no specific details on fiscal policy, trade policy until probably the first quarter of next year, as you said, what is the rally that's currently that we're seeing in small caps, in banks? What is it going to be premised on? Are we going to rally on fumes going forward after this, initial first 2 weeks of euphoria?
I mean, that's just it. We're kind of rallying on the hope of better things to come. So I think a lot of that is priced in.
Yeah.
And I think maybe equity markets probably calm down here, and fixed income markets, I'm sure, calm down. And I think those things are kind of happening in tandem.
All right, Ken, always a great conversation. Ken Shinoda, portfolio manager at Doubleline Capital, kicking us off to the close here on this Monday afternoon with a big focus here on the market reaction to last week's election, with crypto right now, at least Bitcoin at a record high, small caps getting there as well. The dollar also seeing a big bid. We're going to break it all down with you with Thierry Wizman, global FX and rate strategist over at Macquarie.
Plus, a major potential merger in the healthcare industry falls ill, why the failed deal is sending Cigna shares all over the place.
And we're going to take a look at some of the biggest individual movers here in the equity market, and that includes Pinterest. Those shares higher after Wedbush calling the negative reaction to that company's third quarter results overdone. We're not done here. Stick with us. A lot more coming up here on The Close on Bloomberg.
Cryptocurrency companies were some of the biggest donors in this year's election, with the industry collectively spending $135 million. And it appears it paid off, with Bitcoin alongside Coinbase hitting new heights today. Joining us now is Kara Calvert. She is Vice President for U.S. Policy at Coinbase. And Kara, thanks for joining us. A lot's been said of the fact that so many U.S. elected officials, from the highest office to those in Congress, were elected who are pro-crypto. But what does that mean? Beyond supporting the space and saying that they support crypto, does that mean that they'll leave the space alone or that they'll pass specific measures?
Yeah, the goal is to have legislation that is passed, to have longstanding regulatory regime that withstands the test of time. So whether it's a year, 2 years, 4 years, 10 years, that we have clear rules of the road here in the United States that allow us to be competitive, protect our national security, protect consumers. So the goal is still to pass legislation, is still to get a regulatory regime in place. And we're excited now that more than half of Congress is coming in pro-crypto, and not just pro-crypto, or they're actually not just neutral. They're pro-crypto. They're engaged. They're more than open. We're seeing that in the Senate with 9 senators coming in, new senators who are going to be engaged, and then obviously President Trump with his very clear vision, I think, for the future of crypto in the United States.
And it should be mentioned as well that these are not necessarily tied to one party or another. It kind of goes across the board. So what is the number one priority when it comes to legislation that the industry wants these elected officials to push forward with?
Yeah, so right now in the United States, we have an interesting system here where we have digital asset commodities and digital asset securities. So we really need the regulators to work together and stop the turf war moving forward. And we think that legislation is the best way to do that. There was a bill in the House called FIT 21 that set out a really good framework. I think the goal before Congress adjourns this year is to pass legislation that does create those foundational rules and allows both the CFTC that regulates digital asset commodities and then the SEC who should be regulating digital asset securities to enable them to go forward and provide these two markets a robust way to move forward.
You think that bill is going to get passed this year, Kara? You think that before the new Congress comes in January?
These are complicated issues. I think the goal is whether it's a narrow approach or a comprehensive approach like FIT 21. I do think that we should have some rules of the road going into the new year. The CFTC needs specific congressional authority to do that with digital asset commodities. So that is a bit of a foundational issue for Coinbase and for other market participants. And then you also have stablecoin legislation that has been hugely important for the last few years and has been, again, all of these bills are bipartisan. Stablecoins is very much one of those bills that we think could get done in a bipartisan fashion.
So I'm curious, though. I mean, once we get to January, and based on what we know about the potential complexion of Congress, we know the Republicans will have a modest lead in the Senate, though we're only talking, at least based on right now, what looks to be like 4 vote differential. So all you really need are 4 maybe moderates who decide they want to push back against sort of the party core. In the House, you're going to have a similar narrow margin here. What gives you the confidence, no matter what support that you do have in some of those members of Congress, what gives you confidence that collectively they'll even be able to get to a vote?
Such a great question. And I think at the core is that this has been bipartisan for years. This is not something that has been controlled by either party. So whether it was last year with, again, the FIT 21 vote with 79 Democrats supporting nearly every Republican and voting that out of the House, I think we've seen that similarly in the Senate, where you have the Senate Ag Committee who have come together in years past to try to pass legislation. We have seen Senator Schumer and other leaders in the Republican Party talk about the need to pass legislation. So because I think of the the bipartisan nature of this historically, I think it will continue to be bipartisan. And we think about this pro-crypto majority. We've heard a lot about red waves, blue waves, what's happening before the election, what's happened after the election. When I look at the map right now, I see a purple wave, and that's really the color of both stand with crypto and the idea that crypto or crypto voters, they've arrived.
I mean, I am curious about that, though, Kara. I mean, Coinbase, I should say, at least the group that was backed by Coinbase, the political group that was backed by Coinbase, the amount of money that they spent heading into this. And when you go through the ads and you go through the strategies in a lot of those states, you guys weren't running on a crypto platform. I mean, you may have been backing candidates that back crypto, but that's not what those ads were about. So I am curious as to why you took an approach to go after the voters in a way that didn't necessarily talk about crypto specifically, yet this is a victory for crypto writ large.
Yeah, so there were really a couple of different entities that were at play here. And I think you're largely talking about the work of Fair Shake, which is a super PAC that was supported by dozens of crypto donors, from large to small. Coinbase was obviously a proud donor to that organization. What they did is focused on those candidates that were, in fact, pro-crypto and making sure that, again, they created a pro-crypto majority. And those ads, they really spoke to all voters about issues that mattered in their communities. Then there was a second organization called Stand With Crypto, and that was an organization that was focused entirely on the grassroots crypto community. And over 1.9 million Americans signed up for Stand With Crypto in about a year. And so that, I think, really demonstrated that these were everyday Americans who want pro-crypto policies, who showed up to vote, and who were looking for candidates who cared about their issues in how they're framing up the importance of next year. So Stand With Crypto was a really important piece of this, but certainly between Fair Shake, Stand With Crypto, and then all the rest of the organizations, I think, brought it to the forefront and made it a political powerhouse.
All right. Well, certainly, definitely warrants a bit of a victory lap. But Kara, as I know, given all your years in Washington, a lot of the big work still ahead. We wish you the best, and we'll have you back on anytime you want. Kara Calvert there, Vice President for U.S. Policy over at Coinbase, as we continue our coverage here on The Close, counting you down to those bells. Was a closer look at one of the big movers on the day, and that is Pinterest. The shares popping higher on the back of an upgrade over at Wedbush. We speak to the analyst behind that call next. This is The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls, the big movers on the back of analyst recommendations. And we're going to start off today with, well, what else? Tesla. The shares extending their election rally for a fifth day. Wedbush analyst Dan Ives boosting his $300 price target to $400, $5 shy of the company's all-time high set back in 2021. He notes that the incoming Trump administration win will be a game changer for Tesla and Elon Musk. Shares up 7% on the day. Next in line, let's take a look at Cisco, a lift to overweight from neutral over at JP Morgan, with the analyst citing a recovery in the networking business and further valuation headroom for the stock as reasons behind the upgrade. The price target nudged to 66 from 55. The shares in the open market up 1% to 58.66. And finally, let's take a look at Tanger. This is the real estate investment trust that focuses primarily on retail factory outlets here. An upgrade here as the analyst showing that he is impressed by the company's strong leasing performance and robust pipeline of retail store openings. An upgrade to buy today, a price target at 40, up from 35, and the shares moving higher to just about $36. And those are some of our top calls. We do want to stick on that theme of fashion and retail because it brings us to another stock we're watching. The social media site Pinterest, whose shares are up about 5% today. This after an upgrade to outperform over at Wedbush. The analyst there saying that some of the negative stock reaction that followed the company's third quarter results, that was overdone. Scott Devitt is managing director over at Wedbush, and he joins us now to talk a little bit more about that here. And just kind of lay out the case here, Scott. When we talk about this idea of the potential, whatever potential there is in Pinterest, what are you seeing?
Well, the company's going through a turnaround. They had an analyst day a little over a year ago where they laid out the strategy on a 3 to 5 year forward basis, and they're executing fairly well. Investors always want things to happen, too quickly. So when you get a quarter that doesn't work out perfectly, you get a reaction like you got on Friday with the stock down 15%. That said, where we sit now, the stock's as cheap as it's ever been. It trades at 12 times forward EBITDA. We expect the company's going to grow EBITDA close to 30% on a compound basis the next 3 years, and that the changes that they've made to the interface, as well as the monetization improvements that they've made, are still on the come and really going to begin to play out in 2025. So the setup off of the sell-off is just outstanding. We really like the stock from here.
We'll talk about some of those monetization efforts. I mean, we kind of teased into you with the kind of a look at fashion and retail, the idea here that there is more to Pinterest than just being an ad platform.
So, Pinterest, it's always been a great place to find content for consumers. It's been a difficult place to transact. And so what the new management team, has been doing is bringing in,
Yeah. Go ahead, Scott. I think we are having some issues with Scott's shot there, but I think he was getting to this idea too. I don't know how much you've sort of palled around on Pinterest here, but you can see something, you see a dress someone posts, and the idea is that you can sort of click directly through that into a way to buy it, and the idea is that Pinterest gets a cut of it.
Yeah, no, that's part of it, but I've always never been able to get in. Now I'll Google something, it'll come up, but then once you go in, you have to have a login, and it just seems like too much work. Yeah. So there seems to be a lot of friction in there. All right, Scott, we have you back on. Scott, you there?
Yes.
Okay,
yes,
great. You were saying?
What I was saying is that the monetization capabilities have lagged for years, and that's exactly what management's been focused on addressing. So things like direct linking, so that you can click on items on Pinterest, take you to the merchant site and conduct commerce. And then what is kind of the next phase of this potentially is actually even conducting commerce on Pinterest site itself. And so anytime in our history of covering the internet that you reduce friction to transaction, it tends to lead to very good results for advertising platforms. And that's the phase that Pinterest is going through right now. We think 2025 is going to be a very positive year for that. You'll see accelerating growth and a stock that's closer to 40 than 30.
Right. So monetization obviously is the key here, but how much bigger can Pinterest grow its user base? Monthly active users at 537 million makes it feel more niche-y than a wide user base.
So they've beaten user expectations 7 quarters in a row now. So it is niche-y. That is true. But it's a big opportunity for the company to broaden out the content in such a way that it makes it have higher utility with more consumers. And that actually has been working. What I think has been slow to develop is this monetization capability. So the user growth is actually working. And I think that, that's a positive development in the past 12 months. And now 2025 will be the year that they can drive monetization. If you put those two together and they can do that consistently over an extended period of time, the stock is very cheap.
All right, good stuff. Scott, really appreciate it. Scott Devitt of Wedbush on Pinterest. Now, coming up, we're going to speak with the chairman and founder of Interactive Brokers about the record overnight trading volumes they saw right around the election. This is The Close on Bloomberg.
This is the countdown to the close, just about 3:30 p.m. here in New York. I'm Romaine Bostick.
And I'm Scarlett Fu. And the post-election rally that we've been seeing in the markets since Wednesday, losing a little bit of steam. Still there, but losing some momentum.
Well, losing steam, but it's actually kind of rotating too, right? We talk about the strength that we're seeing in the Russell 2000, obviously the strength in Bitcoin and crypto, and even the strength in the dollar. So while the S&P and the NASDAQ aren't getting a whole lot of love today, money's still flowing around, or at least among the areas that people think are going to benefit from a Trump administration come January.
Yeah, I guess if you want to make stock market and big tech like the same thing, then maybe losing a bit of steam there. Tesla, of course, doing very well, but Tesla on its own reasons, because Elon Musk is seen definitely benefiting from his friendship with President Trump.
Yeah, that was an amazing gamble that he took, right? I mean, when a lot of people were like, why is he doing this? Blah, blah, blah.
Paid off.
And we hope so. You got to stay in the good graces of the big man upstairs there, right? And I'm not talking about God.
You're not talking about the God. All right. One of the big takeaways from this presidential election cycle was the power of the prediction market. Because for weeks leading up to the contest, prediction websites were cited as showing former President Trump as the favorite over Kamala Harris, even as poll after poll saw it as a toss-up. And one of those sites was Interactive Brokers. Their ForecastX prediction market saw a volume of over $560 million in presidential election contracts traded and saw record trading activity on election night. Here now to discuss is Thomas Peterffy, Interactive Brokers chairman and founder. Thomas, good to speak with you. Thank you for joining us. I really appreciate your taking the time. Tell us a little bit about what you were most surprised by from the prediction market's performance in the lead up to the election and the aftermath.
So we have started ForecastX we were applying for that with the CFTC, and it took us 2.5 years to get it approved. And we finally started in late September. And then we were very lucky because in early October, election markets became permissible. Up until that time, they were not. So when we put on the presidential election and some of the swing state senatorial elections and House and Senate control, we did that around early to mid-October, and then by election night, as you said, we had $560 million coming in only on the presidential question. So the way it works is that we're asking, will Kamala Harris be elected, or will Trump get elected?
Right.
And you can say a yes or no. You can buy a yes or a no. And when the two bids sum to 101, then we execute the trade.
Right.
The winner gets $1, the loser gets nothing, and we keep 1 cent.
I see.
So that's how it works. And of course, you can buy 1,000 contracts, which say if it's 48 cents for a yes, then $480 to win $1,000.
So Thomas, one concern or even criticism is that these prediction markets are not very liquid. That the spreads are massive. Talk to us about how you've made sure that that's not the case.
Well, it's absolutely not the case because there were millions of dollars on both sides all the time. So that was not true at all. They were very liquid. And besides, you can use limit orders. So say you're willing to pay 45 cents, but no more. So you put in a bid for 45 cents.
All right. So, Tom, talk to me a little bit here about the potential growth from here. I mean, we've seen, of course, not only with what we saw with IBKR, but obviously Polymarkets and a few others, the impact that they had, or at least that they had, and it was still relatively small. Most people predict that will grow, that the market for this will grow. How much growth are you expecting?
So I expect enormous growth because we are listing basically existential questions, such as global warming or the national debt, which we have to face up to. And when people are asked these questions today, they either say, oh, forget about it, that's just talk, or they get hysterical and say, oh, we're going to be cooked in 10 years and nobody will survive. So that's the wrong approach. We have to have a realistic, rational approach to these questions. And the way to do that is for people to engage in these markets and tell us what they think, because we will always have a consensus estimate. So we have a contract, for example, will the global temperature 10 years from now be 1 degree higher than it is today?
Right.
Yes or no, right?
Okay.
Now, as we go along over the next 10 years, we will make certain steps. We either ignore the problem, in which case it's more and more likely that the temperatures will rise. So the answer for the yes will start going up, and the answer for the no will start going down.
Right.
Namely, we are showing that it's more and more likely that the temperatures will increase very fast. So then if there is legislation to do something that maybe bring it down, then the yes will start coming down and the no will start going up. So legislators and the entire world will know what we're doing about this problem.
Okay.
So,
do we not have that now, though? And that's primarily driven by actual like scientists and stuff, or am I misreading what's going on?
That's just talk. Some people say, maybe they are right. Other people say, no, they are wrong. Some scientists are in favor. Some fewer scientists are opposed.
Okay, but no offense, Tom, but I mean, the folks on your site, I'm sure there are some smart folks on that site, but why would I believe that they would have any better read into where temperatures are going as opposed to...
If you don't believe it, you take the side which you believe.
Okay.
So it's your money, right? So take advantage of it. If one side is underpriced, then you should buy it.
Okay.
Right?
That's one way.
But wait a minute. In addition, so 10 years is a long time.
Yes.
It is a long time.
So people would be reluctant to make a bet for 10 years, right?
Right. That's not like an election.
The thing is that we pay interest. We pay interest every night on the closing price of the contract at 0.5% on their Fed fund rates, and that's very important.
I see. So people are going to get paid to wait, essentially, as we wait to see whether that bet comes to fruition. Thomas,
but wait a minute. My point is that if you buy the temperature for 40 cents, and as it goes along and it rises, it goes to 45, 50, 55, you get interest on the then prevailing price.
I see. So it sounds like
every day it matters.
Every day it matters. It sounds like these existential questions that you're posing here, the goal is to create engagement or to inspire people to engage in it and to get Congress and lawmakers to come up with solutions. Is that what I'm hearing?
To get a consensus opinion about all kinds of questions about where we're going, right? Because, that's a better way to run the world than the way we do it now, which is we're trying to guess.
Yeah. All right, Tom, we got to leave it there. Wish we had more time. Interesting developments, and it'd be interesting to see just how much this market grows. Thomas Peterffy there. He is the founder, of course, of Interactive Brokers. Stick with us. A lot more coming up here on the big program with just about 20 minutes until we get to the closing bells. A discussion here about Cigna and Humana, a major merger souring for a second time. It's our stock of the hour, and we discuss next right here on The Close on Bloomberg. Another deal dead in the water. We're talking about health insurance giant Cigna, which has confirmed that it is not pursuing a combination with Humana, even as investors praise a potential presidency in January as a positive move for M&A. The shares moving in opposite directions today. Abigail Doolittle joining us right now to break down exactly how this deal fell apart and, well, is there any hope of it, being put back together? Abigail, I think a lot of folks were looking at this merger from the start and saying that it was kind of doomed to fail. But then there are a lot of people looking at the election and saying, well, the M&A environment is going to be a lot different potentially come January. Why didn't they just try to stick this out a little bit longer?
I think it has to do with price. At least that's what some of our folks down at Bloomberg Intelligence had told me, specifically Glenn Lossoff. And if it were to come back alive, it would be because the Humana shares would come higher. Humana is basically 50% off of what it had been at the start of the year. So for Cigna, that would be a great deal. But for Humana to sell at that kind of a discount, it really wouldn't make that much sense. Now, of course, as you were talking about before, this is the second go around for a potential deal. The first time it was also price. So these companies are having a hard time getting together. But there was good reason to think that they did really want to make this happen because you had Cigna starting to divest some of its Medicare Advantage business. That's pretty much all of Humana's business, so that they wouldn't have that overlap. And now with the new Trump administration and changes potentially at some of those FTC and the DOJ, we don't know that's going to happen, but we can suspect that that might happen. Although, as I say that, I think J.D. Vance, he was a big outspoken fan of Lena Khan. And wasn't that true?
Yeah, but he doesn't make the policy.
He had a lot of policy positions, Abigail, that seem to have shifted over the last few months.
Just throwing that out there now. We don't know exactly how things are.
And he doesn't speak for the president-elect either.
No, that's true. He does not.
Yeah.
So it sounds like this is a combination that makes sense, but Cigna wants to do it now because Humana is on sale, and Humana doesn't want to do it now because it's on sale.
Well, we don't know that for sure. This is just Glenn Lossov's thinking about it, because in terms of the M&A environment, in terms of Medicare Advantage, it would make sense for them to do it. So why wouldn't they want to do it? From Humana's standpoint, not enough money. Now, if Humana all of a sudden, a year from now, that stock price recovers, Could this deal be back on the table? You know, anything is possible, but the official word from Cigna is they want to focus on buybacks, and they also want to focus on what they remains committed, this is a quote, remains committed to its established M&A criteria and would only consider acquisitions that are strategically aligned, financially attractive, and have a high probability to close. So high probability.
Is that unique? I think every single CFO and CFO goes into these mergers.
Well, financially attractive, Humana would be hugely financially attractive. Strategically aligned, it seems like it would be pretty strategically aligned. And
then high probability. So that seems logical too.
It seems as though these boxes are being checked off. So again, that leads to what probably led to the demise of the first deal talk or price.
Yeah. There you go.
All right, Abigail, thank you so much. Bloomberg's Abigail Doolittle. I think if we were to take everything J.D. Vance said and kind of follow through on what happened, the world would be a very interesting place.
Yeah, let's just say don't. I was about as diplomatic as I could be on that one here. And I think to your point, too, in all seriousness, though, we do know how Trump runs things. And we know that, quite frankly, if you don't hear it out of Trump's mouth,
it doesn't matter.
You better hold off until you do.
It doesn't matter. So that's what it all comes down to. All right. As we head towards the closing bells, we've got about 15 minutes left. And, I really wonder how much more steam there is behind this rally in small caps.
Yeah.
Especially because the profitability is not there.
I have to tell you, everyone I've spoken to seems to think that this time is legit. And a big part of it really does have to do with the regulatory environment. The idea that this is going to be a much lighter touch. Obviously, that has a big feed through and a lot of things going on in the small cap space. So we'll see.
Especially the financial companies in the small cap space, if there's M&A
We'll see.
deals,
it's still November 11th, and we got quite a ways to go before we actually get an administration.
All right, coming up, we've got Larry Adams, CIO of the Private Client Group at Raymond James, joining us as we count you down to the close. This is Bloomberg.
The rise in yields started when the probability of a Trump win started increasing after the September FOMC meeting. And we saw a big sell-off on election night and in that morning. But the market's kind of settled down here. I think it's kind of a little bit of a buy the rumor, sell the news.
Doubleline's Ken Shinoda kicking us off to the close just about 50 minutes ago. Of course, no rise in bond yields today, but that's because it is a holiday here honoring our veterans. So the bond market is closed. Stock market is open, picking up that rally that we had post-election.
Although we should mention Treasury futures are somewhat lower. So maybe that's indicative of what happens when trading does resume. But taking a look at the S&P 500, holding on to a gain right now just under 6,000. So this would be another record high if we stay in the green. The Mag 7 are higher, but almost entirely on the back of Tesla. Alphabet also advancing, but everyone else is declining. And we talk about the rotation trade remain, rotation into financials, rotation into small caps.
That rotation into small caps is pretty significant here because we talk about this idea of how much a lot of these stocks got left behind out of the last sort of cycle that we went through coming out of the pandemic here. And now at 2436, fewer than 10 points away here from the Russell, reclaiming a record high that it hasn't seen in more than 3 years. Larry Adams joining us right now. He is the Chief Investment Officer of the Private Client Group over at Raymond James as we count you down to the closing bells with just about 9 minutes to go. All right, Larry, let's talk about this rotation here. I mean, we've seen all the repositioning around the Trump trade, and probably one of the biggest parts of that trade that stands out is the embrace of small and mid-cap stocks here. Give us a sense here as to how much, more legs you see in that phase of the rally.
Well, I still see more upside with that small cap trade. And even before the election, I think there were a couple of things that were very positive. First of all, valuations relative to large cap stocks were very attractive. Historically, small caps tend to outperform when the Fed starts to cut interest rates. And by the way, that outperformance tends to increase if, in fact, we get a soft landing, which is our base case scenario. And then I think what's really important is that for the first time in 2 years, you're actually going to see small cap earnings turn positive. And when we go to next quarter, that trend's likely to continue, if not exceed their large cap counterparts. So I still think the small caps will continue to do better based on fundamentals, not necessarily who's in the White House.
Well, with regards to who's in the White House and the potential policy changes that could affect the market, was there anything in terms of how you look at the various asset classes and you look at the potential risk and reward of those asset classes? Did anything materially change in your outlook based on the outcome of what we saw on November 5th?
Well, if you take a broader perspective, we don't ignore politics. However, if you look at our 10-point framework that we use to assess the equity market, it ranks number 8 in importance. It's far more important to know how the economy is doing. What is earnings growth? What's valuations? What's the Fed doing? Those by far and away outweigh what the composition of Washington is going to be. Now, that being said, again, we don't ignore it. There are some things that could potentially impact our forecast. For example, if the economy does do better because of some of the animal spirits that are kind of erupting here and we get better growth, well, obviously that could have a positive impact on earnings growth, and that could cause us to take our earnings and target for the S&P 500 higher. But on the other hand, you got to make sure that, for example, tariffs could negatively impact margins of consumer-related companies that get a lot of their imports from China. So right now, we haven't changed our forecast, but we are keeping a laser focus on any of those potential policies that do actually get implemented.
Yeah, no, that's an important point, and it's a reason why everyone's so focused on whenever President-elect Trump does speak and give any kind of indication of how he moves forward. When do rate cuts start to really show up in the financial results of especially the small cap companies that are so much more levered to borrowing costs?
Well, I think you're starting to see that now, right? So the markets are forward-looking, and as you mentioned, small cap stocks tend to be more levered because they get more than 50% of their financing with short-term floating rate debt. So they are immediately starting to get relief as the Fed has already started to cut. And we think that the Fed does cut another 4 times next year, which will continue to alleviate some of the pressures that they've had from a financing perspective. So I think it's being priced in now.
What about the stronger dollar? Because that's been another part of this Trump trade, the dollar gaining strength and continuing to do so, given expectations of faster U.S. economic growth. At some point, that's going to be bad news for the big cap companies that rely so much on overseas sales.
So I do think that that could be a negative for large cap companies because of the fact that the dollar's stronger. But I think you have to offset that it also could be a positive from the inflationary standpoint, right? A stronger dollar tends to help us from an inflation perspective because it makes goods overseas more attractive. And you also have to remember that a lot of the goods, are imported from overseas, and that could help from a margin perspective for some companies. So I think you have to take both sides of that equation and not just necessarily say that a stronger dollar is necessarily negative for large cap stocks.
So kind of wrap this up for us, Larry, in the general sense here of kind of where we're going. And I know it's difficult to kind of know definitively here, but we talk about a bull market that, I don't know, I guess depending on where you look, it's either young or to some people might say it's long in the tooth, depending on when you started here. But when you look at the economic fundamentals and you look at whatever we think is going to come out of Washington, is the backdrop, the foundation there, going to be supportive of more meaningful gains on the S&P and S&P that right now is at right around a record high?
Well, to answer the first part of that question, I still think we're about midway through this bull market. Historically, they last about 5 years. We just celebrated the second-year anniversary of this bull market. However, you got to remember that we've just had a monster rally in the equity markets, right? If you look at 3 months before the election through last week, we've been up 15.6%. If you go back and look at every other election going back, that's a record amount of performance during that time period. 7 times higher than what you get on average historically. That's led to valuations. If we look at trailing multiple of the S&P 500, it's at 25. That's the most expensive coming out of an election that we've seen outside of COVID and the tech bubble. And then when I look at earnings right now, I actually look at it as a mixed picture, right? If you look at the number of companies that are beating their earnings estimates, the magnitude of the beats, they're not necessarily better than what we've seen over the last 10 years. So I think there's some caution to be warranted. I think there's a little bit of over-optimism right now in this market. So I think a cooling off period would actually be healthy for this market, and we can resume this bull market as we go into the latter part of this year into next year.
Yeah, and of course, sometimes that's exactly what happens. Larry, always great insights out of you. Larry Adam, he's the Chief Investment Officer of the Private Client Group at Raymond James. As we count you down to the closing bells, 2.5 minutes to go here, Scarlett, and pretty much where we started the program here with the Dow higher in record territory, and the Russell also making meaningful moves.
And as long as the S&P 500 finishes in the green, that's another record high as well. One thing that we didn't get a chance to ask him about is if yields, the 10-year yield gets to 5%, that starts to make equities look a lot more painful or less attractive.
Yeah, though it depends. I thought it was interesting. I was talking to somebody about the small cap trade because I was kind of curious as to where it was going, and we're going to maybe have to pick up this conversation in just a second as we get closer to the closing bells. Full market coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlet Food, taking you through the Closing Bell, a global simulcast. It starts right now. Tim Stenovic in the radio booth. Emily Grafeo in today for Carol Master as we welcome our audiences across all of our Bloomberg platforms, radio, television, and that includes our partnership with YouTube. Tim Stenovic, record high for the Dow. The Russell 2000 at one point came 1 point away from a record high itself, Tim. Pretty good day.
You know what is at a record?
No.
Bitcoin.
Oh, I heard.
Yeah, every time I look at CRYP Go on the Bloomberg terminal, I just see a sea of green.
Yeah.
Bitcoin up another, 9%?
Yeah.
$7,000 higher.
Yeah.
Around $87,000 per Bitcoin.
Does this mean the crypto show will continue?
Oh, the crypto show.
Yeah.
We are on tomorrow. You know, we were off last week because of the election.
I heard.
So
you should have been there.
Tomorrow's an extra special.
Yeah, I'll talk to
show.
somebody for you.
You know, it's kind of surprising to see the NASDAQ 100 end the day in the red when Bitcoin is higher. Usually you see those two trading in tandem.
Yeah, well, I mean, if you look at the Mag 7, it's all Tesla today, essentially. Maybe a little bit of contribution from Alphabet, but Tesla is the star of the Mag 7, and everyone else is kind of on the back foot as people rotate away from those names into small caps.
Yeah, and it's kind of interesting, too. We're kind of headed into kind of a weird period where there's not going to be as many catalysts as we had really over the last 3 weeks or so. The election's out of the way. The Fed is out of the way in earnings season, at least starting to wind down. The lion's share of the big companies, of course, have already reported with a couple notable exceptions. The VIX still tamped down here. And we still got dollar strength here as well. So it's kind of interesting to see how all of this stacks up. And of course, we have to wait for the bond market to reopen Tuesday to see whether that sell-off in treasuries continues here as yields continue to push higher and what that backdrop is going to mean for equities. We do get the closing bells here on this Monday afternoon, and there is a lot to cheer about here. Modest gains to be sure. Let's actually start from the right side of your screen there. A NASDAQ composite that had been in the red for a good portion of the day, now punching into the green. It takes a while for these numbers to settle, but it looks like it is going to settle in the green, only up by less than 0.1%, but that's going to be good enough here for another record high. The NASDAQ 100, though, still in the red. The S&P 500 looks like it is going to settle in the green, up about 0.1%, above 6,000, a record high. The Dow Jones Industrial Average up 0.7% at a record high. And the Russell 2000, which at one point on the day did trade about 1 point away from its record high, falling just shy of that, but still a relatively good day, up 1.5%.
Record highs across the board. Taking a deeper look into the S&P 500, we do see 305 stocks moving higher today, 197 stocks to the downside.
All right, let's take a look at the sector performances as well. The heaviest weighted and most influential group in the S&P 500 is technology, and that, in fact, is the biggest drag on the stock market today. You look at the 11 sector groups, and infotech is down 0.9%. Real estate investment trust losing 0.8%. Healthcare also lower. The big gainers are financials, industrials, and consumer discretionary, and that's really on the back of Tesla.
All right, well, let's talk a little bit about some of those gainers. Scarlett, you went right there. Tesla is my first one. Shares extending gains for a fifth consecutive session today. Tesla shares moving higher once again. Wedbush hiking its price target to a Wall Street high. Shares higher today by 9%. The rally catapulted Tesla's market cap back over $1 trillion. That was on Friday. Wedbush analyst Dan Ives raised the price target to $400 from $300. He came out and said that a Trump White House win will be a game changer for the autonomous and AI story for Tesla and Musk over the coming years. Also, taking a look at pharmaceuticals, Bristol Myers Squibb shares surging. This as a result of loss for AbbVie. AbbVie's new schizophrenia drug failing 2 trials. That setback viewed, though, as a victory for Bristol Myers Squibb, which in late September gained U.S. approval for the new first type of schizophrenia drug in 7 decades. At one point in the day today, we saw Bristol shares jump the most since the year 2000, off the highs of the day, but still finished higher by more than 10%. And finally, talking quite a bit about crypto today, given all the action that we've seen in the crypto market, MicroStrategy, it's a levered play on Bitcoin. We did see crypto-linked stocks just surging today. Crypto being boosted by President-elect Donald Trump's embrace of digital assets. The company MicroStrategy bought about 27,200 Bitcoin for around $2 billion. It was the largest purchase by the company since just after it began acquiring the digital asset more than 4 years ago. MicroStrategy has outperformed every company in the U.S. over that period. Even NVIDIA.
It's funny. I was looking at kind of the outperformance that we've seen, or at least the stocks that have rallied the most since the Trump trade. Obviously, in the S&P, it's basically Tesla, and I think some of the financial companies were in there as well. But yeah, when you sort of broaden it out to that small cap space, include some of those small and mid cap names, it's all crypto all the time.
All right, well, let's get to the decliners. I'm looking at AbbVie, the biggest drop since March 2020, down 13% today after 2 mid-stage trials of its schizophrenia drug failed to meet their primary goal. The drug did not show a statistically significant improvement in symptoms, and higher doses did not appear to be more effective. The failure of the trials set to be a setback for that pharmaceutical company. I'm also watching Super Microcomputer because this was one of the worst performers in the S&P 500 on the day, and it's the worst performer in the benchmark index over the last month, down 50%, coming after a number of kind of bad news for this company, a scathing short report from Hindenburg on Super Microcomputer. There was no real fundamental news driving the stock lower today, but I'm just guessing it's kind of all of those headwinds or tailwinds on the company. And they also had some earnings misses last week. And then finally, Monday.com. It was not a Monday for this company, not their Monday. Stock down 14% after the software company reported third quarter results, which Citi said had missed elevated expectations. Some consumer metrics also slightly softer relative to recent quarters.
All right. This is the part where my producer tells me to talk about yields. But of course, the Treasury market is actually closed today for the Veterans Day holiday. So I'm just going to actually read you some entertainment news here.
Okay.
I'm learning that Megan Fox is pregnant now by Machine Gun Kelly. Also, it's Leonardo DiCaprio's 50th birthday. Congratulations to that guy and his yes.
Hold on.
Congratulations to him and his 25-year-old girlfriend.
There you go.
And then also here, some other interesting news. Just crossing the wire here, Bobby Flay signing a new multi-year deal at the Food Network. That's courtesy here of Variety.
I get all my news. I'll get all my celebrity news from Scarlett because she follows this stuff closely.
I did not know it was Leo's birthday, but I'm glad you mentioned.
Sure. That's what I'm here for.
Life.
Anything else you want to talk about?
There's a good story, especially as we gear up for earnings season for retailers. Macy's, of course, going to be one of the retailers that will be reporting, and they're really changing the way that they are presenting some of their best-selling products, and that would be shoes. They kind of needed to fix things because there are too many things available on the display floor. It was kind of like they're trying to match Amazon with all the different selections, and it just overwhelmed people.
Well, I sort of like this, and I'm gonna tell the story. So years ago, I interviewed at the time the CEO of Lord & Taylor, which of course is now kind of defunct. But she made a big stink about this idea of kind of being anti-Macy's, the idea that Macy's was too cluttered and that they were trying to create a program. And this was like, I don't know, it's like 25 years. I'm dating myself. This must have been like 25 years ago. So it's kind of interesting to see that now they finally sort of found religion and realized that. Yeah, and I do think so. I mean, as somebody who pops in there from time to time, it does seem like sometimes it's just too much there. And I know maybe some people like that. But I feel like the minimalist trend, like that's in now. You go into some of these boutiques on Madison Avenue, they got like, it's like 5 dresses in like a 25,000 square foot space.
The word is curated,
Yeah,
right?
I was going to say.
Okay.
I mean, look, I think that makes sense in an environment where you can go to your Google search bar and type in basically, men's or women's shoes and see tens of thousands of options. So you kind of want some guidance. You kind of want some guidance where you're going. You want help. We'll see if it plays out for them. We'll see if it works for them. I mean, Tony Spring's got a big job in turning around Macy's and kind of figuring out where it goes from here.
Emily, do you shop there?
So I was going to say, I like trying on shoes in the store. I haven't been to a Macy's because the one on 34th Street is a little chaotic to go into. But I do like trying on a bunch of shoes. So I would prefer to go into a shoe store that had a really big selection.
So they do want you to try on shoes, Emily. That's part of it. But they want to make it more streamlined, and they want to make it so that you don't have to wait 5-10 minutes for someone to disappear into the back and get your size, right? And they can do that if there are fewer shoes on display. And they can also point you in the direction of, we don't have that in this color, but if you want to order from our website, we can send it to you for free, deliver it. And those are all options that they present. Certainly they did when I was at Bloomingdale's a couple of months ago, and they didn't have what I was looking for. But, because there are fewer options available, they're able to set you up with delivery right away.
But that's basically the value proposition that a brick and mortar store has to offer, right? It has to offer something that you can't get online. And I guess that in this case would be a curation experience where you can talk to somebody whose job it is to actually do this, and they can match you with the right pair of shoes. once again, we'll see if it works.
All right, I just want to bring you some earnings here. Tim Stenovic, Live Nation crossing the wire right now. The company reporting revenue in the most recent quarter of about $7.65 billion. That's a slight miss. Street was looking for 7.8. Operating income, though, does look like a beat at roughly about we'll round it up, $910 million on an adjusted basis. Street was looking for roughly 857, shares higher by 7%.
Wow, yeah, stock surging in the after hours. We'll see what they say on the call. Reminder that earnings season not quite over at this point.
It's never over, Tim. It never ends.
It's never over. Hey, what is over is our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're going to be back with you all tomorrow, same time, same place.
A lot more coverage coming up here on Bloomberg Television, including a deeper dive into the gaming and entertainment ecosystem. That's on the heels of those results that we just got out of Live Nation. A conversation up ahead with the CEO of Mohegan, Ray Pineault. You don't want to miss that. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. And how about a resumption of that rally? Of course, this post-election rally that has sent most of the major indices to fresh record highs today, certainly for the Dow, certainly for the S&P 500, not necessarily for some of the big cap names. You see the NASDAQ 100 sitting this one out, though only down by a fraction of a percent on the day. But the real story really involves the small cap stocks. The Russell 2000 adding 1.5% on the day here. And keep in mind, at one point in the day, it traded above that 2440 level. Remember, the record high for this company right around 2442. So within spitting distance of a record high that it hasn't touched, even come close to in about 3 years. A big part of that, Scarlett, of course, has to do with some of the bids that we've seen into financial names. And of course, the animal spirits out in the crypto world. Bitcoin now up more than 30% since the election.
Yeah, both are key components of the Trump trade, the gain in financials and the gain in Bitcoin. Let's take a look at some of the day's big movers. Romaine mentioned Bitcoin. Crypto companies certainly advancing. Coinbase jumping 20% on the day as Bitcoin topped $87,500. We also have some big moves in drug makers. AbbVie seeing its biggest decline since March of 2020. This is after its new schizophrenia drug failed 2 trials. And this drug, by the way, was the prize of AbbVie's $8.7 billion of a small biotech firm last year. Meanwhile, that's good news for Bristol Myers, which, of course, has its own new treatment treating schizophrenia, and it recently gained approval for that. So that stock up almost 11%. But our top story this hour goes back to the Trump trade. Based on the rally in stocks, Trump 2.0 is seen as good for business, certainly for banks and small caps, along with those adjacent to cryptocurrencies and Elon Musk for that matter. But what about tariffs? Higher levies will increase costs for companies and their customers while denting earnings. New tariffs will also boost the U.S. dollar, which may lead to currency devaluations by U.S. trading partners to stay competitive. Romaine?
And of course, a big part of that Trump trade is the dollar, touching its highest level in a year, with a lot of traders really thinking this idea that President Donald Trump's trade policies will actually boost the dollar even further. Thierry Wizman and the team over at Macquarie saying euro dollar can weaken to 105 in the aftermath of that victory. Pleased to say that Thierry joins us right now. All right, let's get right to it here. I mean, we've already seen about a 1% bump here, at least in the Bloomberg dollar index, Thierry, and we're up 5% on a year-to-date basis here. How much more room do you see?
There could be a little bit more room, Romaine. I think people are just getting excited about the prospect for U.S. growth under the new administration. And of course, the dollar tends to do well when people get excited about growth. And I would surmise that that's an added layer, an added reason for why the dollar is doing well, besides the general issue around tariffs and the prospect that could drive U.S. inflation and cause the Federal Reserve to be tighter. There is an underlying growth story here, and I think it is also capturing the attention, the minds of traders here. Of course, this was already in evidence even before the election. You both had the Trump trade driving the dollar higher, but you also had this whole concept of American exceptionalism, better data in the U.S. driving the dollar higher. And I think this is just taking the dollar higher again post-election as well.
I am curious as to the role that foreign investors will play in the strength or maybe lack thereof in the dollar. Obviously, they're going to really determine here just how much exceptionalism we have. Do you think that even once we start to see some of those policies, the anticipated policies in effect here, they're still going to have the confidence and the faith to buy U.S. dollars?
Well, I mean, I think what this speaks to is whether or not foreign investors are currently overweight or overinvested in the U.S. or underinvested and underweight in the U.S. And based on all the anecdotal evidence that we see, they're still underinvested in the U.S. There seems to have been a reluctance over the past year and a half to buy in to the idea that the U.S. can continue to print growth numbers that are superlative to the rest of the world, that there has been a reluctance to buy in to the MAGA 7 story, for example. And I think there's a possibility that this cash sitting on the side, not really in the U.S., mainly from abroad, can continue to come into the U.S. market and drive the U.S. dollar a bit stronger.
Terry, how do you think about the carry trade, the yen carry trade? Is that still alive? And I know a lot of it depends on how Japan responds to the weakness in the yen. We have the Prime Minister Ishiba getting enough votes to stay in the top job for now, but he needs to put together an economic stimulus package, and he needs to meet with President-elect Trump soon as well.
Yeah, so the reason the dollar yen has been going higher, the reason the yen has been weakening to some extent has to do with the overall, Trump trade and the stronger dollar. But remember, there's also been a bunch of reluctance signaled from the Bank of Japan as to whether or not they want to continue hiking the base rate in Japan and whether or not they're going to do it in the first quarter again of 2025, raise rates again. I would say that if the Federal Reserve continues to move in a hawkish direction and the BOJ is reluctant to raise rates there, you could see dollar yen move a bit higher. But my view here is that just buying dollar yen is probably not the right trade at this point. The right trade is actually maybe to go long the yen against the Chinese yuan. We suspect that on the basis of what we expect to happen with tariffs, it's really China that's going to get hurt, not Japan, or certainly not Japan as much as China. And that speaks to going long the yen and shorting the yuan, as opposed to doing anything in dollar yen at this point.
Oh, interesting. Interesting pair there, yen and yuan. So what other pairs would you be looking at in the aftermath of Trump's election?
Well, we've also talked about the euro weakening versus the pound sterling. It's pretty clear to us that the Bank of England, like the Bank of Japan, has been a bit reluctant to pursue, in the case of the Bank of England, a more dovish policy. And as a result, and this is coming out of the budget that was proposed in the UK, as a result, we may see the ECB be much more aggressive in easing policy rates over the next few months in the Bank of England. So that certainly supports a weaker euro versus sterling. In the emerging markets, we've talked about the possibility that the Brazilian real could do better than the Mexican peso within Latin America, in part because we are also concerned about the implications of the Trump administration on Mexico. There is a risk out there, let's say, that the USMCA treaty does not get automatically extended in 2026. I think that's going to weigh on Mexico for the next few months until we get clarity on that situation.
Is there any concern here, Terry, when you talk about the trajectory of the dollar, about some of the policies coming outside the U.S., the idea that obviously Europe has its own issues that it has to deal with, and that's going to have a huge impact on the euro, potentially weaken it versus the dollar, but also some big policy decisions as well coming out of places like Latin America and even Asia?
Yeah, so look, as long as there's uncertainty in the rest of the world with respect to the policy direction that some of these countries are going to take in view of a Trump administration taking power in the U.S., I think that's going to speak to a stronger dollar. I mean, the dollar is viewed as a haven currency, and whenever there's uncertainty about what direction policy in other countries is going to take, even if, just as long as there's uncertainty, as long as there's the lack of a resolution of uncertainty, it tends to benefit the dollar. What we've seen in the U.S. in the last week and a half is resolution of uncertainty. Up until recently, we didn't know who was going to be running the show in Washington. Now we have clarity, and I think that's working to the dollar's benefit relative to just about any country out there where we're still not seeing clarity. So, for example, in Mexico, we really don't know how the Mexicans are going to address protectionism coming out of the U.S. Just to give you an example, it's the countries that do most business with the U.S., like the Europeans, like the Mexicans, like the Canadians, that are going to see the most uncertainty coming out of the election.
All right, good stuff. Terry, really appreciate your joining us today. Terry Wizman is Global FX and Rate Strategist at Macquarie Group. Coming up, we're going to turn now to politics because Donald Trump's cabinet is in focus as he prepares for his return to the White House. Anthony Scaramucci, managing partner at Skybridge Capital and, of course, former White House communications director, will join us next. This is The Close on Bloomberg. President-elect Donald Trump's cabinet is starting to take shape. Congresswoman Elise Stefanik will serve as the U.S. ambassador to the UN. Tom Homan, the former immigration chief, has been tapped as Trump's border czar. And hedge fund billionaire Scott Bessent is on the short list for Treasury Secretary. Joining us now to discuss these personnel decisions is Anthony Scaramucci. He is managing partner at Skybridge Capital and famously former White House communications director. Anthony, thanks so much for taking the time to speak with us. Trump 1.0 was marked by a lot of turnover. You know that well. But in 2024, the GOP is completely united behind Donald Trump versus back in 2016. And it feels like these folks will hit the ground running. How much work is this cabinet in waiting going to get done between now and January 20th?
Well, I mean, it's a good question. I think that because I still talk to a lot of people in Trump land, there's lists of things that they'd like to do. And of course, they can't effectuate the government until January 20th, but they'll probably have reams of things that the president will sign on that day and in the first week in the White House. Some executive orders that will probably tighten the border, some executive orders that will provide greater clarity on things like the regulation of crypto, energy drilling, et cetera. I think one thing that people like myself are concerned about is the right to citizenship and the birthright issue. So not to overly get into that on a business show, but if you have a immigrant mom who perhaps is here illegally and she gives birth, are you not a citizen? And I think we've always said that people in that standing as a citizen, I just don't want them to overly affect the culture, which will affect the business community. It's just that they're all can join together. So the economy's doing quite well. The president's team is going to inherit a rising stock market, a rising economy, rising wages. And so, I just hope and pray they'll do a good job with the team that they put together.
And of course, I know that you do speak with a lot of people in Trump land. Do you expect there to be as much turnover this time around as there was in 2016 when people were kind of just, figuring out how the government worked, many of them perhaps not having worked in government before?
So, I think what happened in 2016 was that the RNC was sort of like a large corporation, and MAGA, the president's movement, was more of like a startup. And when he won, that startup took over the large corporation. So there was a very big culture clash inside the administration. And I think that's what led to lots of departures, lots of confusion. There were separate lines. Reince Priebus was running a sleeve. Steve Bannon was running another. Jared was running a third sleeve. I don't think you're going to have that under Susie Wiles. She's worked with the president for just under 2 years, and they have a good relationship. And I think it'll be more centralized. And I think that'll lead to more continuity and less argument and probably less departures.
I am curious, Anthony, about the economic team, if you will, and we can just start with the Treasury Secretary, because that's probably going to be one of the most important positions that Trump picks, at least for the markets here. Scott Bessent, of course, his name has been bandied about, Howard Lutnick, and a few others there. Who would you like to see in that seat over the next couple of years?
Well, listen, the one I know personally is Howard. I have a 15-year relationship with Howard. Obviously, I think he's a very gifted guy and very commercially gifted. I don't agree with a lot of the things related to the sentiment that Mr. Trump is professing, but I do like the regulatory clarity on crypto, and I do like some of the deregulatory aspects on the banking system, which will allow the banks to be more competitive with the global banks. Howard is the one that I know the most, if you will. I have a personal relationship with him. Scott has an incredibly good reputation. He's a very moderate guy and would do a good job. Both of these guys, I think, are going to be compared to Steven Mnuchin, who, frankly, I think did a very good job for President Trump. Treasury Department's a no-drama position. There's a lot of people that want to return to Treasury for President Trump. And so either of those guys or some of the other guys that you have up there listed, I think would do a very good job in those roles.
Well, I'm glad you brought up Mnuchin, because he's probably one of the few cabinet level members that I think, for the most part, most people seem to applaud and say, he did a good job, whether you're a Democrat or a Republican. He was also one of the few to sort of ride out the entire 4 years. And he seemed to have been given a certain degree of autonomy that other cabinet members didn't necessarily have. Do you think that this go round, this Trump 2.0, given that, at least in theory, he's going to have probably a lot more power and sway now that the RNC, or at least the traditional RNC, is out of the way, do you think he's going to afford that Treasury Secretary, this new Treasury Secretary, that same sort of long leash?
So it's a really good question. So I know the history between Stephen and President Trump. They had done a number of deals together. I think they did a hotel deal in Hawaii together that was successful. And of course, Stephen had worked very successfully on the campaign. I just don't know the president's relationship with Howard or Scott. If it's as fluid as Stephen, then yes, I do believe, the president is more focused on things like immigration. He'll be more focused on foreign policy, the issues that are going on in the Middle East and what's going on in the Ukraine. And so I do think whoever gets that job, the president will probably give them more latitude. But it also depends on the relationship, the personal relationship that the president has with those guys. And so I think he knows Howard the longest, from what I can tell. But I'm just not as conversant in those relationships.
Speaking of long leash, let's talk about the Federal Reserve. You know how President Trump thinks, and he's been not shy about making clear that he wants low interest rates and saying that he feels a president should have say in that as well. At the news conference last week, Jay Powell, the Fed chair, made clear that he is not going to step down and that under law, he's not allowed to be fired by the president. Do you see this coming to a head?
So I don't. I'm going to take the contrary view of this. I think a lot of people that supported President Trump heard a lot of things that he was saying and said, okay, well, he's not really going to do that. That was just the rhetoric and the heat of the campaign. There was sentiment on the left that they were going to tax unrealized gains. I think this is the doppelganger, meaning there's nobody on the right that wants to end the Fed's independence. If President Trump moves to end the Fed's independence, I am very certain that people like Scott Bessent and Howard Lutnick would explain to him that we have the deepest liquid capital markets for a reason. The dollar remains the reserve currency for a reason, and it's generally been because of the independence of the Fed and the very good guidance that the Fed has provided over 100+ years. So I don't think they want to go in the Erdogan direction or what he did to the Bank of Turkey. We know that you can't have the political leadership running the Fed. That would be a recipe for inflation and a recipe for disaster. So I think that's rhetoric.
Yeah.
And I think that the market is also where I live on that. I think people would be shocked if they said, hey, we're going to roll the Fed into the federal government and end its independence. I think it would wreak havoc on the markets.
Yeah, absolutely. Anthony, I do want to talk a little bit here about the market reaction to the election, the so-called Trump trade, if you will. As we're speaking right now, Bitcoin hitting a fresh record highs here, right around that 88,400 level here. And there's a lot of talk here about that. The different sort of regulatory approach to the crypto sphere. I mean, I guess anything's going to be different than what we got out of Gensler, but a different regulatory approach to crypto. Obviously, the election of several congressional candidates who have pledged to be pro-crypto. How much weight do you put behind that as a catalyst for more meaningful gains beyond what we already had? And we're up like 30% since the election.
So you see, I think that the whole thing has been ridiculously depressed, meaning you haven't found price discovery in Bitcoin yet, or assets like Solana or Ethereum, primarily because of the debacle that took place in 2022, and then the requisite ridiculous regulation by enforcement, the capricious nature of the regulation, the various lawsuits that the SEC lost. I think, Gary Gensler, frankly, has probably been the worst commissioner that we had in the 90-year history of the SEC. And I think when they're doing the autopsy on the side of the Democrats, it's really Elizabeth Warren and Gary Gensler that weightily contributed to them losing the House and Senate because, the crypto people got involved. They were looking for fair regulation. No one's looking for laissez-faire regulation. They're just looking for rules-based guidance, not regulation by enforcement. So I think we're going to get that. And I think what you're seeing right now in the marketplace is the market is now searching for a level of fair pricing that we likely would have had Gensler just complied with the laws. When when you got the Bitcoin futures approved in November of 2021, it would have made sense to anybody that looked at our administrative law that say that the cash futures would have been approved 3 or 4 months later. He made Grayscale go through a lawsuit. He made a lot of people's lives nightmares, if you will, for no reason. Of course, he lost that lawsuit. Those things came into place in January.
Yeah.
But now that the market can see that it's going to be more fairly regulated, it's searching for the right price for Bitcoin. And we're still at a very low price for Bitcoin, frankly, in terms of what Bitcoin is to the world. It's not a stock, it's an asset class, and it should trade a lot closer to where the market capitalization is of gold.
Staying with price action, I think back to when Donald Trump was first elected in 2016. Every time he spoke, it was potentially market moving. It could have been on anything: tariffs, regulation, bilateral relations. And Romain and I had to cover every headline because it did move markets. How do you, as someone who manages assets, runs a hedge fund, prepare for the onslaught of remarks that will move prices on a dime?
Well, we'll have to see. It could be different. The president's 8 years older than when he started. I think there's a lot of things that happened over the last 4 years that may change his opinion of certain things in terms of when to tweet and when not to tweet. It's quite possible. I think him being on Truth Social actually helped his campaign. I think a lot of the stuff that he said on Truth Social that frankly didn't get onto Twitter or Instagram, didn't permeate the marketplace, it's probably beneficial to him. When he's saying that he's going to use the military to go after his political adversaries, or he's going to have treason tribunals and things like that, the fact that it was limited to Truth Social, I think, was beneficial. And we'll have to see what he decides to do. But if he's doing that sort of stuff, mayhem will ensue. There is a reason why he was voted out of office in 2020. We took sort of the sedate, more stable grandfather over the crazy uncle. And so we're back with the crazy uncle now. And people don't remember how crazy he was for those 4 years. And hopefully he isn't. Hopefully he's more sane. I'd like to give him the benefit of the doubt. We lost the election fair and square. He won the popular vote, which I think is very good for the country. So it settles that argument. And I'm an American. I wish him well. Like to see them govern well. I'd like to see our country more peaceful, more prosperous, and the lower and middle class people doing well. And I hope they can affect policy that allow that to happen. But if he's tweeting nonsense, it will cause mayhem and volatility in the markets.
All right, gonna have to leave it there, Tony. Appreciate you taking time to be with us. Of course, a lot of unanswered questions, and we're going to start to get those answers come January. Anthony Scaramucci, managing partner over at Skybridge Capital, and of course, former White House communications director.
All right, let's turn to earnings because we did get some results. Live Nation shares on the move right now, higher by 5% after reporting third quarter adjusted operating income that beat analyst estimates, although revenue did decline for the first time since 2021. Joining us now to break down these earnings is Kevin Neer, equity research senior associate analyst for Bloomberg Intelligence. And Kevin, that revenue drop gets my attention, mainly because there are fewer stadium events during the summer, but we also know ticket prices were incredibly high.
Exactly.
And so that turned off a lot of consumers.
Exactly. No, you're exactly right on. You have to remember coming into the quarter, management did telegraph that this was going to be a slower revenue growth quarter. I mean, with the stadium-sized events, you got to remember, not only is that high attendance, but it's higher ticket prices as well. So you're going to see that show up on the revenue line. You're going to see that show up on the gross transaction volume line. But really, I think you have to look at the profit. This was a great read for Live Nation. Highest ever concerts AOI, 7.2% margin, really, really strong growth overall. And what we were looking for was the demand outlook. How is it looking going forward? How are those 2025 sales pacing? And they're up double digits. So it's really, really good read. Is
there any sort of read on broader consumer spending and broader appetite for these types of, let's face it, the ultimate sort of discretionary experience?
You're exactly right, Romain.
Yeah.
With concerts, we've been looking a lot at this in BI recently, and what we're seeing is these concerts, it's a sense of FOMO, really. People are using that as a reason to purchase these tickets. When you might see softness at theme parks, Comcast, Disney both pointed out that they're seeing weaker discretionary spending there. But for a concert goer, you're thinking, when's the next time that a Post Malone is going to come into my town? It might be years. So they are willing to spend a little bit more. Yeah. Where you will see the demand come in softer, and which we haven't seen thus far, is on-site spending, right? So people will still pay to buy the ticket. Maybe they won't buy that expensive beer when they're there.
But most of Live Nation's revenue and profitability comes from those ticket prices, not necessarily the discretionary spending that comes alongside, right?
That's right. Ticketmaster is still the engine, the profit engine for this company. Again, sponsorships, very, very strong as well, up double digits, and that's a very, very strong, over 60% margin on the sponsorship business as well. But Ticketmaster is still the bread and butter. Again, as we said, we saw a little bit lighter on the top line. But again, I think the outlook is what you have to pay attention to.
How many times have you seen Post Malone, Kevin?
Personally, I've gone twice in the last 2 years.
Oh, there you go. Kevin Neer, keeping the Post Malone economy alive, the best of Bloomberg Intelligence. As we continue our coverage right now of live events, and who better than talk to than the man behind Mohegan, of course, has the big casino company. And of course, they run a lot of big events as well, including the WNBA's son. CEO and President Ray Pineault joining us right now around the desk here in Studio 2. Great to have you here.
Thank you for having me. I really appreciate you giving me the time to be here with you.
Let's talk about that discretionary spend, because, of course, we know the casino environment, which really encompasses a lot more than gambling. As, of course, you know, of course, it's concerts, basketball, a lot of other things there. Are you still seeing pretty healthy appetite for that stuff?
You know, listen, when we came out of the COVID period, obviously, you know, resort operations had a significant spike. I think we're seeing more of a normalization now and a return to normalcy, which I'm okay with, because it's nice, steady growth, and there's no, you know, unexpected ups and downs. So I'm hoping that we can avoid that for a while. But I'm pretty happy with what we're seeing at the performance at our properties, and, you know, continuing to evolve and meet our guests' needs. And I think we continue to do that. And I think that you get acceptance from your guests when you're able to provide them.
Have you noticed any shift in spending? We've talked a lot about how the consumer might be hurt by inflation and other things. Are they spending less when they come to your resorts, or is it about the same? What are you seeing?
So over the last 6 to 9 months, it's about the same. I think that we had a spiked period in there for about 1.5 to 2 years where, you know, there was extra money in the economy and people had extra money in their savings accounts. So it kind of spiked all discretionary income spending at that point in time. And now it's cooled off, and it's about the same. We're hoping to see, nice steady 2 to 3% growth. We're in, what I would consider mature markets. They've been around for a long time. Mohegan Sun, our flagship in Connecticut, has been open over 28 years now. So, it's kind of in a steady state now. And what we need to do is continue to evolve and grow and bring new products to our guests to continue to encourage their discretionary spending at Mohegan Sun and our properties.
Right. That's part of the, description of things normalizing, that you fall back on the strength of your brand, of your reputation, and what you offer to your customers. Mohegan Sun, one of the most prominent Native American-owned businesses in the world. You're in Connecticut, New Jersey, Pennsylvania, and Canada in the Niagara region. What do you understand about those specific markets better than bigger competitors like a Las Vegas Sands or an MGM?
Listen, I think it's a very competitive environment, whether we're talking about Sands or Wynn or Caesars, right? Those Hard Rock, all big competitors for us. But we fall back on our culture and our brand and who we are. We never sacrifice who we are when we talk about our culture and making sure that it's a team and family environment. We talk about our team as our team. We're all in this together, and we walk about this together. And what's important to us is making sure we bring our culture to wherever we go. But as we're going into these new jurisdictions, we're also mindful of the jurisdictions we're going into. We have to be mindful of their culture. We have to be mindful of the way that they do business while bringing our culture there and being mindful of that. Okay,
so one of the jurisdictions you're looking to enter is New York City. What is the latest on your pitch to win a downstate casino license?
So obviously it's a crowded field in New York City. We have a pretty definitive timeline, we think, right now that the state has laid out for the bidding process. We've been working diligently on putting our response into the RFA, and we know that we'll have that ready come June time when we think they're going to call for the RFAs. We have the largest undeveloped land in New York City. It's almost 7 acres right off the FDR Drive. Tremendous access when you think about the ease of access of getting to this piece of property. We've been in the New England region for 28 years. We know the consumer. We know what they're looking for. We know how to appeal to the New England guests. That's where our flag is started. That's where we're from. So we understand the New York market. We understand this entire region, and I think that we have a very competitive presentation to put forward to the state.
It's interesting you bring up the location on the FDR. I don't want to make this too hyper-local, but as you know, some of the competing bids, of course, are more focused on the west side, and that seems to be, at least from what we heard from this administration, the Adams administration a few months ago, that they were leaning a little bit more towards that part of the city. Are you worried at all that might actually undercut you?
It's going to be a competitive process for me, right? I mean, I don't think there's any given in any of this. There's at least 10, 12, 14 competitors that are going to be going for it. And they're all formidable competitors. So I don't want to diminish anything that anybody else is doing. What we're going to do is put the best product forward that we possibly can. We believe we have a very compelling project that is going to rank with the best of any of them. And we're going to provide not only that, but we're also going to provide the city with affordable housing and a museum, along with park space, things that are badly and sorely needed in New York City. So we think we have a compelling project. What ultimately happens is we're going to put our best foot forward. We believe that we're the best project for New York City. But ultimately, all we can do is put our best foot forward and then let the process play itself out.
All right. Speaking of expansion, you also recently opened a $5 billion integrated resort called Inspire in Seoul, South Korea. The casino will be a small part of the project, which matters because, according to Korean law, only non-citizens can legally gamble. So what do you anticipate the breakdown to be? Will it be like 80% non-gaming, 20% gaming, or more like 50-50?
So right now we're targeting more of a 50-50 break. It is a much smaller casino when you think about U.S. casinos, where U.S. resorts, I should say, not casinos. The casino is a larger portion of the overall footprint. That is not true in Incheon, where we are. It's a much smaller footprint. In fact, the number of slot machines that they have there is only about 1/5 of what we have in Connecticut. But the number of table games is about the same, if not a little bit more. In the Asian region, they're much heavier table games players than they are slot players, but we're also banking on all the amenities that we're bringing there. So when you think about all the dining, all the shopping, we have a water park that's there. We have a 15,000 seat arena. We have 1,200 hotel rooms. We obviously have our spa. We have a convention center. So it's not just relying on the gaming aspect of it, because as you pointed out, Scarlett, this is a foreigners-only casino. We're also attracting this 25 million people that live in the greater Incheon, Seoul area that we're bringing out for all the other amenities, including the outside park that we have that people can come and enjoy.
Just real quickly, we only have about 30 seconds left, but I do want to circle back to your property in Connecticut, and specifically with the Sun, the women's professional basketball team. As I'm sure you know, Boston wants your team. Are you going to give it to them? Listen, they say it should be the Boston side.
The interesting thing is it's a great partnership. We actually had a game in Boston. I don't know if people are familiar with that. And we sold out TD Garden.
And that's why they're saying they should move there.
Well, you know what? We sell out the Mohegan Sun Arena, and they do a fantastic job. And we were very fortunate. Caitlin Clark's first professional basketball game was at Mohegan Sun.
Yes, we did. We all watched.
And I'll stay at Mohegan Sun as far as you're concerned. Ray, thank you so much for joining us today. Ray Pineault is Mohegan President and CEO. Appreciate it.
Thanks for having me.
All right, let's take a look at how markets closed on the day. Just a reminder here that we did close at record highs for the S&P 500, closing above 6,000 by 1 point. 1 point remain, although the rotation is in full swing as small caps get a big bid.
All right, we'll be back in a moment. This is The Close on Bloomberg. All right, time for a look back at this day in history. 11 years ago, that was the day Blockbuster Video began to dim its neon lights. It was the end of a 28-year run for the video rental retailer, a run that began with a single store in Dallas, Texas in October 1985. It laid the foundation of a corporate superstore concept for a video rental industry that was highly fragmented and highly local. Blockbuster, it was a wild success, but within 20 years, the company's growth would peak with roughly 9,000 stores at the end of 2004, a number that plunged by more than half by the beginning of 2010 as the streaming model pioneered by Netflix finally took hold. By the end of 2010, Blockbuster had entered Chapter 11 bankruptcy protection, and by 2013, announced it was closing its remaining corporate-owned stores. And that brings us to our question for this day in history. November 11th, 2013, that was the day Blockbuster announced it had rented its last movie ever, just a couple of days prior to a customer out in Hawaii. And what was that final movie? Well, a fitting, if not ironic, apocalyptic comedy starring Seth Rogen and Jonah Hill called The End. This is the End. Even more ironic is that, well, more than a decade after Blockbuster threw in the towel, the company most responsible for its demise, Netflix, is now getting into the brick-and-mortar game itself. While it doesn't plan to rent movies, the stores will let fans immerse themselves in their favorite Netflix shows, shop for branded merchandise, and eat TV-themed food. The first two locations, they're set to open in 2025 at the King of Prussia Mall in Pennsylvania and Galleria Dallas in Texas. Swanky. And while Blockbuster, the company, technically no longer exists, there is still one remaining store left that you can visit if you so choose. You can find it right there at the intersection of US Route 20 and Revere Avenue in Bend, Oregon. Now, it's a franchise location that still has the legal right to use the company's name and color scheme, though it gets no other support when it comes to marketing, inventory, etc. Still, being the last Blockbuster standing definitely has its perks. The store, which opened back in 1992, has around 4,000 paying members and has become a tourist mecca for nostalgic movie fans. Scarlett?
Love it. I didn't realize that it still existed. There was a TV show on the last standing Blockbuster as well. I think it was just called Blockbuster, and it streamed on where else? On Netflix. All right, let's turn back to earnings for a moment here, because Home Depot is set to report tomorrow, and the home improvement retailer's same-store sales expected to drop for the 8th straight quarter, according to Bloomberg Intelligence. Joining us now to discuss is BI's U.S. home building analyst for us, Drew Redding. So, Drew, when we talk about the comparable sales declining, staying in the red, how much of that is an indication of what home transactions, housing sales look like?
Right. So housing has certainly had a huge impact on Home Depot's results. If you look at where we are in the housing market and the resale market, which is the bulk of the housing ecosystem, transaction activity is at the lowest level in over a decade. So, we know that movers spend more than non-movers. So the fact that we're not seeing that activity in the market is really something that's held them back. Now, consensus is looking for a decline of about 3%, and that's pretty much in line with some of the store foot traffic data that we look at, which saw transactions down about 3% during the quarter. But we think they did a good job last quarter of de-risking the second half of the year. Kind of bringing market expectations more in line with what we think they're likely to report.
I am curious about the potential for a forecast and what that forecast could look like. There was a lot of talk, of course, about the house selling season of 2024 that never really materialized. If we do get a more normalization in 2025, combined with the drop in interest rates, how much of an upswing does that potentially provide for a forecast going forward?
Yeah, if we are able to see a pullback in mortgage rates, we do think that will be a powerful tailwind for the housing market and Home Depot and Lowe's in particular. That being said, we saw mortgage rates come down to 6% in September. We saw corresponding improvement in activity, but within just a matter of weeks, we saw mortgage rates back up 90 basis points, and we saw data start to slow again. So I think mortgage rates are really the linchpin, and we'll continue to see how things trend. There are expectations that we could see a return of inflation, which may limit the Fed's ability to cut rates further. At the same time, it's not just mortgage rates, though. Home prices play a huge impact in the affordability crisis we're seeing. And the analysis we did in the market shows that existing home prices would need to fall about 30% for monthly payments relative to incomes to get in line with historical averages. So there's a lot of moving pieces and cross currents for these companies.
Yeah, so it's so sensitive to eco macro trends. Very quickly, Drew, is there anything in terms of growth drivers that Home Depot can pull on its own?
Yeah, I think in the near term, both Home Depot and Lowe's will probably see a benefit from the hurricanes. We think they'll see a little bit of benefit this quarter, and that's something that should play out, in the coming quarters into 2025. If we look bigger picture, we like Home Depot's exposure to the professional contractor. They're getting more into what they call the large complex project, which is a big untapped market for them.
Yeah.
They recently completed the acquisition of SRS Distribution, and we think that's a key growth driver for them as we look out, past this near-term weakness.
All right, Drew, got to leave it there. Drew Redding over at Bloomberg Intelligence. A closer look at Home Depot. That company is scheduled to report earnings tomorrow morning. The share is higher by about 17% since it last reported. We're going to set you up for some of the other potential market-moving events over the next 24 hours when we come back after the break. This is Bloomberg. Here are some of the potential market-moving events over the next 24 hours. Earnings in the pre-market from Home Depot, Shopify, Hertz, and Tyson, as well as some big earnings after the market as well.
Yeah, so we'll get a read on the consumer here, especially with Calvert Group, as well as Maple Bear, which owns Instacart, SoundHound.
Did you really call it Maple Bear?
I did, because technically that's a company name. It's official, right?
Yeah. They need to change that. Jag Sound out also reporting. We're also going to get a read on small business optimism at 2 a.m. as well as a few other things interesting at 2 p.m. Scarlett.
Yeah, the Senior Loan Officer Opinion Survey, or SLOOS. It's a good read on demand for loans. And there's a lot of Fed speak. Yeah, Waller, Barkin, Harker, and Kashkari. And I don't know, maybe the rest of the Fed will speak as well, because why not? Anyway, Scarlett and I will be back here tomorrow covering all your market action for you right here on The Close. In the meantime, all your politics coverage. It starts in just a few minutes at the top of the hour right here on Bloomberg.